Hi guys, Vipin here. Yesterday I made a video on the origin of the banking system. Today I'll tell you a little bit about the banking system in India and some of the banking jargons that you will come across in your day-to-day lives. So let's get started. The banking system in India is regulated by the Reserve Bank of India. Reserve Bank of India is a statutory company. Now I'll tell you a lot of details of how statutory companies are established, why do you need a statutory company in a different video, but just know that a statutory company is one that regulates a particular industry. Now for example, SEBI is a statutory company that regulates the securities markets. Okay, you have TRAI, Telecom Regulatory Authority of India, that regulates the telecom business in India. Now you have IRDA, Insurance Regulatory Development Authority. They regulate the insurance business in India. So just like that, you have RBI that regulates the banking sector in India. And then the largest bank in India is State Bank of India. It's not only the largest in India, it's also one of the largest banks in the world as well. So these guys are pretty big in terms of the size of operations, the scale of operations they're actually into. There are both nationalized banks and private sector banks in India. Nationalized banks are those which are government owned. Now in the 1970s, the Congress government did something amazing. Yes, believe it or not, they have done something amazing. They took over a lot of banks which were once upon a time owned by private authorities. Private companies had these control of these banks, and the problem was that they were restricting their services to a limited population. For example, if you didn't have a large amount of money, you couldn't open a bank account. Now that restricted this vital service to a major population of India. So Indira Gandhi in the 1970s decided to take over these banks and say that these banks are now government owned, and those banks are referred to as nationalized banks. Okay, Syndicate Bank, Canara Bank, Bank of Baroda, all these are in fact nationalized banks. Even State Bank of India is a nationalized bank. One reason why people prefer to have their account in a nationalized bank is because your money in a nationalized bank account is secure no matter how difficult the bank is going through in terms of a financial crisis. Let's say the bank is having a difficulty in repaying this amount and they're getting into severe losses. Your deposits will not disappear. The government of India has an insurance for your deposits. Now that's what's the wonderful advantage of a nationalized bank. Private sector banks, on the other hand, are those such as ICICI Bank, HDFC Bank, IDBI Bank, Citibank. All these come under the private sector banks. These are not controlled by the government. Okay, they are controlled by RBI, but the government doesn't control them. Okay, now when it comes to private sector banks, the quality of facilities they have, in my opinion, is superior to that of nationalized banks. But what pushes away people to nationalized banks is because private sector banks, when it comes to the minimum deposits, the deposits that you may need to maintain there is extremely high. In case of ICICI Bank, you need to maintain around 10,000 rupees minimum deposit per month. So that's like a turn off for a large amount of people. They can't maintain such a high balance. In terms of nationalized banks, you can maintain just 250 rupees in case of Syndicate Bank, 0 rupees in case of SBI. So this is some info when it comes to the banking sector in India. Now let's come to some of the jargons that are there in the banking system. First, a demand draft. Let's say you want to guarantee payment to someone. Okay, and you want to make those funds for payment locked in your account. You go about issuing a demand draft. Now when you issue a demand draft to someone, that person is guaranteed payment because the funds in your account are locked. Let's say I have to make a payment of 1,000 rupees for my insurance premium. Okay, for my LIC insurance premium. Now I would issue a demand draft wherein the payment is supposed to be made to LIC, the amount being rupees 1000. Now what's going to happen there? The bank will go about locking this 1000 rupees in my account. Okay, and then the payment is made as soon as the institution LIC encashes the demand draft. So this is a way to make sure that the payment is secure. Usually demand drafts are used for high value transactions, and the bank will charge you a commission for the total amount which needs to be blocked in your account. Okay, and then you have overdrafts. Now let's say your bank account has just 5,000 rupees and you have issued a check of 10,000 rupees. In that case, in a normal circumstance, the check would bounce and that would get you into a lot of legal issues. So to avoid that, many people have something called as a current account, usually businesses. Now in a current account, in case the balance in your account exceeds in a particular transaction, okay, the bank will go about adding money from their account and clear away the transaction. So in this case, I have only 5,000 rupees, but I've issued a check of 10,000 rupees. In that case, the bank will go about adding 5,000 from their account and the check ends up getting cleared. Okay, that's what they refer to as an overdraft. Now remember, when it comes to an overdraft, when you want to repay the overdraft, they usually charge you a small amount of interest for that. No bank will allow you to use their money free of cost. They will go about charging you a small rate of interest. Bank guarantees. Now, bank guarantees are a way to guarantee payment. It's like a safety net. How it works is, if I have to make a payment to someone, let's say I own an IPL team, and to my players I have to make a payment. In that case, the amount of money which I need to make as payment, I will go about issuing a bank guarantee as well alongside the regular payment. Now the person who's going to receive this payment will doubt whether I can make this payment or not. To tell him that, look, the money is safe, I can go about making the payment even though I cannot under some difficult circumstance, the bank will make the payment on my behalf. In that case, the money is secure. The money is secured, the transaction is secured in case of a bank guarantee. Then you have a letter of credit. A letter of credit is very similar to a bank guarantee, but this is used in international transactions. Okay. Now, for example, in case of imports and exports, the importer wants to make a payment to the exporter. Now, to make sure his payment is secure, alongside the regular wire transfer which they do, they also have a security which is the letter of credit. A letter of credit is something like, in case the importer is unable to pay, the bank of the importer will make the payment to the exporter. That's what you refer to as a letter of credit. And then no frills accounts. These are banking accounts wherein the basic banking facility is given, but nothing more than that. There are some bank accounts wherein they'll tell you, we will have checkbooks given to you free of cost every time you request it. The demand drafts that are going to be issued in your account are free. These kinds of benefits they go about giving. But for some people like me especially, I don't transact through checks. I rarely go about issuing a demand draft. The last demand draft I issued was making a payment for my BBM fees, and this was in 2008. So I rarely go about using that. In that circumstance, what's going to happen is you just need a basic banking account. You don't want a checkbook, you don't want a demand draft, all that. Those are no frills accounts. Remember, there are in airlines as well, you refer to as no frills carriers. They take you from point A to point B. They don't really offer an extremely luxurious experience. Bank accounts the same way as well. A basic banking facility, nothing more than that. Checks. Checks are a way to make sure that the transaction that you've made, the payment that you've made, is in fact recorded. Now, if I were to pay cash to someone for a particular service that they have rendered, now there is no proof of this payment unless the person whom I've given the cash has given me a receipt. Now, let's say this person hasn't given me a receipt. I can always say that the amount of money I've given him is very high, or the person whom I paid can say that the money was never given at all. But if you go about making the payment through checks, the transaction is recorded and it ensures the transaction is secure. Also, popular belief is people will write a check only knowing that there is the money in the bank to be given for the value of the check that has been written. Now, that's a case to make sure that a transaction is secure and to tell people that, look, don't worry, the money is there, that's why I'm writing this check. Okay? And then some more lingos: repo rate, reverse repo rate, CRR, SLR, and prime lending rate. Repo rate is the amount of interest you have to pay as a bank if you have borrowed money from RBI. Reverse repo rate is the amount of interest rate RBI will pay you in case they have borrowed money from you. Now, why does RBI borrow money from a bank and why does banks borrow money from RBI? That's a different video altogether. That will be part 3 of this, I can say, where I'll tell you how the banking operations actually work in India. CRR is the amount of money which a bank must keep with RBI. This is like idle funds they must keep with RBI. Okay, how much is the CRR rate? 4%, meaning 4% of the bank's cash must be kept with RBI. Okay, and then SLR, statutory liquidity ratio. Statutory liquidity ratio stands at 22.5%. This is the amount of money the bank must keep within their account, and they cannot utilize this money for any of their activities. They cannot use this money to give out loans. They cannot use this money to expand their business. It's just the amount of money that needs to be kept idle. Okay, prime lending rate. Now, every bank has its own prime lending rate, meaning this is the minimum rate of interest we charge on the loans that we give. That's what they refer to as a prime lending rate. Usually, the prime lending rate, if it is a high value, let's say it is 11%, the cost of acquiring a loan from a bank having a prime lending rate at 11% is going to be high, meaning you have to pay a high rate of interest. However, if you see a prime lending rate of say 9%, okay, the cost of acquiring a loan from a bank is going to be much more easier in terms of repayment at least. Okay. Now, these are some of the banking lingos that are there. If you want me to do more videos related to the banking sector, or if you want me to explain any one of these things in detail, do let me know, leave a comment, and I'll always get back to you on that. Okay. Thank you for your time. Have a nice day and do subscribe to my videos. Bye.